everyone, and welcome to The Explainer. Today, we're unpacking something absolutely crucial if you're an international professional planning to retire in Italy. We are doing a deep dive into an essential, highly detailed technical report put together by Francesco Di Tommaso over at F.D.T Consulting. It lays out exactly how United Nations pensions, specifically those from the UN JSPF, are taxed if you're a fiscal resident of Italy. Look, if you're an accountant, an expat, or a retiring UN official, you know that international tax law can feel like a complete maze. But today, we're going to cut through all that confusion, look at the exact regulations, and get you totally prepared for the 2026 tax year. So let's just address the elephant in the room right away. Are UN pensions tax-free? If you work in the international development space, you've probably heard the rumors that UN staff just don't pay taxes. And naturally, people wonder if that incredible perk follows them into their retirement years, especially if they choose to spend those years sipping espresso in the Italian countryside. It's a burning question, and honestly, it's probably one of the most common myths in international tax planning. So is it a myth or is it reality? Okay, let's dive into this, because there is a stark difference between active duty and retirement. For active personnel, the 1946 UN Convention on Privileges and Immunities clearly states that salaries and emoluments are exempt from national taxation. And Italy officially adopted this convention way back in 1957. However, and the F.D.T report is super explicit about this, once you transition into retirement, those pension payouts are not automatically considered salaries and emoluments anymore. Instead, they become fully taxable under Italy's standard personal income tax system, which is known as IPREF. To really understand why this happens, we have to look at the legal logic behind the law. And this brings us to a concept called the functional exemption, or esenzione funzionale. You see, international law recognizes these tax exemptions not as some sort of personal favor or a lifelong VIP tax break, but as a functional necessity. The whole goal is to guarantee the absolute independence of the UN and its active personnel from any single member state. But once an official retires, they just aren't actively performing those independent duties anymore. Therefore, according to Italian tax practice, that functional exemption ends, and the retired resident is treated exactly like any other taxpayer in Italy. All right, moving on to Section 1, what the case law actually says. Let's trace how this builds over time, because the history is fascinating. It starts in 1946 with the UN Convention on Privileges, which Italy formally brought into its own law in 1957 via Law 1318. Now, for decades, there was a lot of debate, but then we hit a massive milestone in the year 2000. The Italian Revenue Agency released Resolution 11E, which really laid down the law on how UN pensions are treated. And if there was any lingering doubt at all, we can jump right to the very end of our timeline, a super recent 2025 ruling by the Lazio Tax Court of Second Degree. That's ruling number 171/2025. This court firmly cemented that a UN or FAO pension received by a former official residing in Italy is, without a doubt, taxable. Now, what's really interesting about this is just how definitive the Italian Revenue Agency's stance actually is. Look at this exact quote from their year 2000 resolution. In the absence of a specific treaty provision, pensions paid by the UN to residents in Italy are taxable for IPREF purposes. The authorities are basically saying, look, unless an international treaty explicitly uses the word pensions as being exempt, which, remember, the 1946 convention doesn't, you have to pay standard Italian income tax. There is literally no gray area here for the Italian taxman. Okay. Section 2. How the declaration works in practice. This is where the rubber meets the road, and it's a process you really can't afford to get wrong. Why? Because the United Nations does not withhold Italian taxes for you. Since this is a foreign payment with zero Italian withholding tax applied at the source, the burden of declaring it falls 100% on you, the taxpayer. Step 1 is perception. The Italian tax code, the 2IUR, qualifies this as income assimilated to employment. It's taxed on a cash basis, meaning it counts towards your total income in the exact year you physically receive the money. Step 2 is the Modello Ready TPF. You or your accountant have to manually declare this foreign income on your Italian tax return. And finally, Step 3 is the application of IRPEF, where you calculate and actually pay the standard national income tax plus any local taxes. Which brings us to Section 3, the 2026 IRPEF tax brackets. So the crucial point here is understanding exactly where your specific pension income lands. Italy uses a progressive tax system, and for 2026, the brackets are locked in. For income up to €28,000, your tax rate is 23%. For the chunk of your income that falls between 28,000 and 50,000 euros, the rate steps up to 33%. And for any income you receive over that 50,000 euro mark, that portion is taxed at a pretty steep 43%. And this brilliantly illustrates the progression. As your pension income grows, the slice taken by the Italian government grows right along with it, capping out at that 43% mark for higher earners. But actually, keep in mind, these base national IRPEP tax rates are only part of the story. The report reminds us that you also have to tack on regional and municipal additional taxes, known locally as addizionali, right on top of these base rates. Now, before you completely panic looking at that 43% top rate, it's incredibly important to remember that your gross pension is not necessarily your final taxable base. The F.D.T. report points out several variables that will actually adjust your final tax bill. First, you've got deductible expenses, or oneri deducibili, that are recognized by Italian law. Second, you have specific deductions designed just for pension income called detrazioni spettanti. Plus, the exact documentation provided by your UN fund can really impact how the income is categorized, and in some very specific scenarios, you might even have foreign tax credits to consider. So yes, the brackets are strict, for sure, but the legal deductions are there to make sure you only pay what's fair and legally required. Finally, Section 4. Evaluate your specific case. I really want to emphasize this vital warning straight from F.D.T. Consulting. Everything we've covered today serves as a general informational framework. It absolutely does not replace a deep dive into your specific individual case. And why is that? Because tax law is intensely personalized. Your exact fiscal residence status, the specific nature of your past relationship with the UN, the tiny nuances hidden in your specific fund documents, all of these require a meticulous case-by-case review by a qualified professional. You just can't apply a one-size-fits-all rule to international pensions. Which brings us to our final and definitely most important question. Are you ready for the 2026 tax season? You've got the knowledge now. You know the UN pension myth is, well, exactly that, a myth. You've seen the legal precedents stretching from 2000 all the way to 2025. And you know exactly what the IRPF brackets look like for the upcoming year. The worst thing you could possibly do right now is just wait around. Take this information, take immediate action, and sit down with your accountant to map out your unique situation. Proper planning today is literally the only way to avoid stressful audits and heavy penalties tomorrow. Thanks so much for joining me on The Explainer today, and happy planning.